Welcome back to the Money Under the Mattress podcast. My name is Mitch and my co-host is Jake. And today we are joined by Sleepwell. We met Sleepwell through Twitter and have been asked by many to have him on. We're stoked to have him on to join us today and discuss Spotify and the new updates surrounding Pershing Square and their following through with Universal Music Group. So thanks for coming on today with us, Sleepwell.
Thank you so much for having me, Mitch and Jake. It's great to meet you, and started recently listening to the podcast and been enjoying a lot.
Well, thanks for coming on, and we're excited to talk to you today. We've been talking to Greenwald lately, and he was like, "Yeah, you got to have Sleepwell on." So we decided to DM you, and we're happy that you coming on today.
Absolutely, shout out to Greenwald, one of the characters on Fintwit.
Yeah, he's a great guy.
Yeah. So for the first question today, I guess we'll just get into how did you get into investing?
Sure. So, growing up as a kid, I was always interested in business. My dad, he was an M&A, still is an M&A kind of banker. He has his own boutique shop. So, I remember as a kid, he'd, come home and we'd talk about all different kinds of companies he was working with. And, I'd ask him different questions about the models and the industries, et cetera. And it just, I think I was always a kind of a curious kid. I liked numbers. I was also into science and music. I'd never, I wasn't one of those kids that started investing when I was 13 or anything. I just never came across the stock market. I think it partly because my father was just not focused on that part of the business, so he never really pushed it. But I know you guys were pretty early on into the process, and obviously, we've all heard the Buffett story when he was 11 and things like that. But I ended up pursuing an engineering degree. So while I was in school, that's when I actually kind of crossed over the stock market, and through a couple of friends, became pretty interested on it, read one or two books very simplistically, and started playing around with it with the little money that I had back then, and quickly realized I was basically gambling. And I didn't lose too much money, thankfully, but I learned a couple of valuable lessons in terms of trying to focus a bit more in how markets work, what a business is, and things like that. So I transitioned into made the decision not to pursue an engineering career, but actually go to work into finance. So had a couple of internships in different kind of big banks, and ended up at working full-time in one of them. And by then I had been learning more and more about finance and the markets, but that's really when I came across Buffett. And I think this story probably resonates with a lot of people, because a lot of people kind of get started and serious about investing when you meet that incredible character. So I discovered the letters. I think I read them in a matter of 1 or 2 weeks. Didn't do much work during that time. Basically spent the whole workday looking through the letters, and I've basically never stopped since then. It's been an evolving process. It's been super fun. It's never ending in terms of learning. So yeah, it's been great.
No, it is. I think it is one of the better jobs in the world. You're always able to sit down, learn whatever you want, whatever industry you want, and at the end of the day, you can make a decent dollar, which doesn't hurt either. So
exactly.
No, I'm with you with that one. Going into your investing style, what would you say, what and who has influenced your investing style the most as of now?
Yeah, so it's definitely a collection of ideas and people. I can't really point out to a specific one. Obviously, Buffett is always a big one, because he's the one that kind of got me started and inspired. But I've learned a lot over along the way, and it one kind of interesting mental model, if you want to call it that Munger talks a lot about, that is focusing on non-investing related fields, for example, as it relates to investing. Because I don't think you can be a really good investor by just, focusing on finance and accounting. There's so much more to it, right? So, the psychological aspect of investing, I think, is one of the big important ideas. And that's not only when it comes to the market specifically, because, at the end of the day, the markets are just people behaving in a certain way. And you have things like sociology coming into play, and it's at different points in time, it can lead to extremes, whether on the optimistic or the pessimistic side. So it's important to understand how a crowd can behave under different incentives, right? But then another part of this psychology that I think I've been spending a bit more time on recently is the psychology as it relates to you as an investor, right? And kind of getting to know yourself. There's a very good quote by Richard Feynman, the famous physics professor, that says the first principle is that you must not fool yourself, and you are the easiest person to fool, right? So I think that quote has kind of gained more and more meaning along the way as you come to realize the things like, making mistakes in investing, your own biases, trying to strike a balance between being humble, but at the same time being confident, gaining conviction, which I think, by the way, is a fascinating topic that, in the past couple of weeks, I've been working on my next Substack piece, and it's actually focused on this specific subject, which is it's much harder and complex than you would think. I'd spent almost 2 weeks just trying to come up with my own definition of investing conviction, because I think it's so different from person to person, right? I mean, a short-term trader looking at the next quarter earnings and kind of trading around that is playing a completely different game than I would when I'm buying a company and planning to hold it for 10 years. So those are different. There's all these different psychological aspects to it. And then, a little bit related to that as well is, I think, the idea of spending time on the qualitative side of investing. Again, if you can't really spend all day learning accounting and financial modeling, et cetera, there's much more to it than that, and kind of being able to craft a story and your own view on a company over the years is, I was trained as a fixed income analyst, spent 3 years kind of doing credit research. And when you're looking at a bond, you're coming at the investment from a completely different perspective, right? Because the first question you always ask yourself is, what can go wrong here? And am I gonna get paid back, right? So that's almost like flipping,
like inverting
stock investing on a yeah, exactly. It's a good inverting exercise, because most equity analysts will come about a company and say, like how great can this company be, right? So you really need to find a way to put those two together and translate that into what it means for the investment going forward, for both valuation as well as kind of how you think the business is going to play out over the next few years. And then you have there's so many people that you learn from as you kind of keep on reading all the great books. We all know the big ones, Joel Greenblatt, some of the more famous investors. I've been recently reading the Nick Sleep letters, which I recommend if you guys haven't seen. He's incredible. And then there's people that you come to realize are kind of industry experts, and they just have such a unique way of thinking about a company or a sector. And Ben Thompson and Matthew Ball really come up as big examples of this when it relates to kind of tech and media. So as I spend more time looking at those sectors, there are people that I've been following pretty closely, and that's probably a great way to tie this whole theme into Twitter, because it's such an incredible platform. I've had the chance to kind of bounce off a few tweets here and there with Matthew Ball, and it's incredible that you can ask someone like him a question or ask him about his thoughts and things like that. But then just more broadly speaking, in terms of FinTwit, I've met, I only started using it seriously over the last 6 months or so, and I've met some really incredible people that I've been able to chat, whether that be through DMs or having, calls and things like that. And, I'd like to shout out to Francisco Oliveira, who you had here. Alex Morris is great. Bill Brewster, obviously, he was the first person I met in person from FinTwit, and now he's this big popular. so big shout out to Bill. But then people like Andy, Eric Borean, John Huber, Josh Tarasoff, Pythia, Connor. I mean, there's so many. I'm probably missing a lot, and I'm sorry if I didn't mention you. And we've been in touch, but if you use it in the right way, and I'm sure you guys have realized that it's just so powerful in so many different forms.
Yeah, like I mean, a lot of those guys that you read off, they were a lot of the people that have started helping us get into the Twitter space. Like a lot of them are just really genuine people. Me and Jake have been going, like we've had Twitter probably for the last 6 months, but we really have only been in FinTwit for really, would you say like the last month and a half, Jake?
Yeah, if that.
Like if that. And then like we just one day, Alex Morris followed me back and I was like, okay, like this is crazy. Signs of hitting followed me. So then I just DM'd him just like to talk to him. I just like, I really like your write-ups and stuff like that. And then all of a sudden he was like, you know what, let's go on a podcast and talk. And then ever since then, we talk quite often, and was able to meet Francisco from that, and Greenwald and many other people since Doc Poppy, and then now you. And FinTwit's been really great for us. Yeah,
absolutely. The more you give to it, the more it gives you back. That's kind of how I've come to realize it works.
Yeah, because I think we were talking to, or maybe it was talking to you, and you were talking about how when you started with FinTwit, you thought like, I don't know about these guys, like different people within the FinTwit community. I think it might be just a waste of time. Or maybe, was it Jake that we were talking to Michael?
I'm trying to think who that was now.
Or did you remember that?
I don't think it was me.
You don't think it was you?
No,
okay.
I don't think it was. No.
Okay,
yeah,
sorry.
no, I think it was
Michael Candelan, and he was talking about FinTwit and how it's helped him out quite a bit. And we just got in contact with him lately, and he was saying like when he started FinTwit, he kind of had to put his ego aside and say like, there's actually really smart people on here, and you don't notice them, and they could have under 50 followers, and these people be some of the smartest and have the best ideas out there. So it's one of those spaces where everyone's pretty kind and just trying to help each other move in the same direction.
Yeah, no, for sure.
Yeah. So the next question, what are your thoughts on Spotify's podcast strategy and their acquisitions? How would you value some of the deals such as like a Joe Rogan and Caller Daddy?
Yeah, for sure. And so look, I think most people know this by now, but to get the disclaimers kind of out of the way, I'm long Spotify. I think their podcast strategy is definitely the right one and will serve as a big differentiator going forward. It's a strategy that right now we don't really have enough data to kind of judge it on a more, that way. It's gonna take some time to play out, right? It's just like the Netflix original content strategy has taken time, right? We can talk about some of the similarities in a bit, but broadly speaking, so they've spent just over $1 billion on podcasting assets, right? So that includes both content as well as things like Anchor and Megaphone. They have $4 billion in cash, give or take. So even though, because a lot of people will just look at the headline number and say, oh, they're overpaying, they're buying all these expensive assets, et cetera. But you have to think about it you have to put some context to that, right? So let's take Call Her Daddy as an example, right? It was $20 million per year, right? So basically for them to break even, they need to, have around 1.7 million listeners and monetize them at $1 per month, right? That's just basically to get back their investments, right? Now, if you look at that podcast specifically, the estimates are she has around 3 to 4 million listeners. She has 2 million followers on Instagram. On the other hand, you have Spotify that has 356 million monthly users, right? So of those, probably close to 100 million listen to podcasts, right? So that's already a huge kind of pool of customers that can potentially find this podcast and become new listeners if they were already not listening to it, right? So on the other hand, this also serves as a customer acquisition tool because you probably have some of those existing users that are very loyal to that podcast to come onto the platform because all they really need is to download the app. It's you can listen to these as a free user, right? So there's other benefits that may not be as obvious than just thinking about that, how much it costs and that's it, right? So you know, there's things like subscriptions that they can work out. They've announced that they're going to start offering premium subscriptions to podcasters, which I think is going to be an interesting experiment. You also have things like, you know, they bought Locker Room and rebranded it as Green Room, basically their live audio offering. So you can have things like shows on there, maybe even charge for some of those. So there's a lot of monetization levers that they can pull to make this work, right? And then just from a customer standpoint, you in general speaking, you get better retention, lower churn, and it increases pricing power. So all of this sounds very much like Netflix, what they have been doing for the past, I think it's 8 years or so, and that's not a coincidence, right? They're basically copying their playbook. If you look at the Spotify board, there's 2 Netflix executives that sit on it. That's again, that's not a coincidence, right? So, you know, will they all work out? Probably not, but I think collectively, it's there's a very good chance that it's going to serve as a differentiator for them going forward. I think another really big advantage that they have that a lot of people miss is on the data side, because when they're going out and bidding for many of these podcasts, not in the case of Joe Rogan specifically because he wasn't on the platform, but if you think about Call Her Daddy, they have all the data in terms of who was searching for it, how they were listening, how engaged were they, how much retention. So they basically knew very well the assets that they were buying, and they have a natural informational advantage versus any other competitor that's going to bid for this content, which results in them being able to pay better prices than the rest, right? So I think that's pretty instructive to kind of think about. And then finally, you know, again, there's not much data that we have at the moment on how these are working. It's management has been kind of vague in terms of the, you know, the results so far. I'd hope we can get a better data going forward in the next couple of earnings calls. But one thing that I encourage people to do is to go to Spotify. If you don't have Spotify, download it, please, and search for podcast charts. Okay, so they have their own kind of top podcasts, whether that's episodes or shows, and you can search for, you know, categories, countries, all these different, you know, data segmentation that you can do to it, and you realize pretty quickly that anywhere from 40 to sometimes 50% of these top 10 or 20 podcasts are already exclusive to Spotify. So they're doing something right, okay? And I expect that to probably increase even more on the coming years.
I have a few questions about Spotify's podcast. So you're talking about the premium subscriptions in the future with podcasts. How would that work?
Yeah, so basically, just to kind of level set the idea here of because there's some complexity to it, right? When you're a premium subscriber, and just for simplicity, let's say you're paying $10 a month for Spotify. If you listen to one song and the rest of the month you listen to your podcast. All the money, all that those $10 are going to go to the rights holders pertaining to that specific song, right? The podcaster doesn't get anything from that specific subscription. What Spotify did was they were able to segregate any sort of advertising revenue related to the podcasts, where the labels obviously will not get any of that. So if you start monetizing your podcast and start generating ad revenue, it's going to be shared between you and Spotify. Now, the next step, which is what your question comes at, is how you can come up with a premium subscription specific to your podcast. And in that sense, you could go out and tell all your listeners, I'm going to start charging $5 a month for a premium segment of my podcast and have, bonus episodes, Q&A. You can get as creative as you want, right? I don't know, your premium subscribers can maybe suggest who your next guest is and things like that, right? And Spotify basically will allow you to keep 100% of your revenues for the first, I think it's the first 2 years, and starting in 2024, they're going to take something really low, like a 5% take. There's some payment processing fees probably associated with that go on top, but in general, it's a very creator-friendly approach that they're taking to kind of benefit the entire ecosystem and grow the pie for everyone, if that makes sense.
That will also, I'm not sure exactly what Apple Podcasts kind of thing will go up against Spotify's once they start monetizing people with podcasts. I wonder if Apple Podcasts will eventually say, you know what, we're going to do this also, because
they already did as well.
Okay,
they announced that the terms are a little different. It's much more close-ended, because at the end of the day, Apple is going to be the owner of the customer relationship. And for example, with Spotify, you'll have access to all your listeners in terms of their emails and things like that. And that's not going to be the case with Apple. And the way that Spotify is differentiating themselves is by being much more creator friendly than Apple in this case. And for example, if you have a premium subscription, you don't even necessarily have to be listening to your podcast on Spotify. Like if you're using something else, you can do that as well.
Yeah, and I know from I've just watched a couple of videos on influencers just on the YouTube space that have their own type of premium subscription website, which would be very similar to if you had a premium subscription part of Spotify. And they said that they were almost astonished by the amount of people that actually were interested in a premium subscription. So some people that did it were if you're familiar with Logan Paul.
I think it's Patreon, what you're talking about, right?
Yeah, the Patreon.
Biggest, and
then
OnlyFans, I guess it's.
And OnlyFans. Yeah. But yeah, no, exactly. Those businesses are very interesting businesses to me, especially as I am a podcaster. And
exactly.
But no, that Jake, we'll have to look into that.
Yeah, we will.
From that type of standpoint. But do you see Spotify starting to make deals with eventually smaller individuals? And I mean smaller within, let's say there's maybe 50,000 monthly listeners compared to a couple million or a couple 100,000 for Joe Rogan and Call Her Daddy?
Yeah, that's a really, really good question. I'm actually not sure. I haven't thought about it. My initial reaction is that when you're not as big, you probably want maximum exposure, unless it's someone that maybe has 80% of their listeners on Spotify for whatever reason. In that case, they probably won't mind. I think it makes sense for them to start at that very high end kind of top of the funnel, because they can afford it, first of all. Second, it's those call it top 20, top 50 shows that really drive the bulk of the listening in podcasts, right? It's a power law distribution, just like it is in music, right? So that's where really you get the bang for your buck, and it's gonna increase all those benefits that I talked about, right? Higher retention, it's gonna bring in new users, etc. So yeah, I'm not entirely I'm not entirely sure. I think they might try it at some point, and maybe the numbers make sense for certain podcasters, but yeah, that's kind of my initial reaction with that.
Perfect. And just one more question about podcasting or podcasts on Spotify. When Spotify makes deals with the likes of influencer Joe Rogan and Call Her Daddy, do they get any of the intellectual property that comes with it afterwards, like after the 3-year contract ends, like let's say for Call Her Daddy?
No, in the case of, so those are basically licensing deals that have a limited time frame, as you said. So with Joe Rogan and Call Her Daddy and a lot of the other deals that they've licensed, it's basically for that set period of time, and they have things like the first right to make a decision on a future show if Call Her Daddy decides to make another show, and things like that. And I'm sure there's some sort of renewal clause in those contracts that maybe give them, another advantageous position when the contract comes up. But they own their IP. I'm pretty certain about that. Where it gets interesting in terms of Spotify owning the IP is with the companies that they bought like outright that create content. So these are things like The Ringer, Gimlet, Parcast, and there's kind of an in-house Spotify as well, the Spotify studio basically. So anything that comes out of those studios, and I'm sure we're going to see another one of those where they're actually like buying the actual studio. So any intellectual property that comes out of that, if a movie gets made eventually or things like that, like Spotify will make money off that.
Perfect. What are your views on the music industry, and what is important to know compared to other industries?
Sure. That's a super important question when it comes to, both an investment in Spotify or the labels, or just in general. I think, I've been studying the industry for more closely the past 2 to 3 years. I've been very lucky to not only have had experience on my own as a musician by hobby, but also being very close to people who are involved in the industry, whether that be as artists, songwriters, producers, label executives. So very basically across the value chain. So that's helped me kind of grasp the complexities and the trends that I'm seeing in the industry for the next decade or so. So I think there are certain things that are well understood and others that are not, right? So let's talk about that first one. That's the easy one where most people would agree, right? So music is a fundamentally different media format than the other ones, right? So think about videos, watching TV, video games, social media. It's inherently different, right? It's mostly passive, but at the same time, it can be super engaging, and you have very sort of passionate fans that follow artists for their entire lives. It's also highly personal. It has a cultural impact. It can be consumed in kind of an infinite variety of ways and combinations. And so that makes it, a very unique format on its own versus other mediums, right? The other one that I think everyone knows and agrees with is that it's clearly the industry that suffered the most from piracy, right? It almost destroyed it, basically. And I think they're probably a decade plus behind in terms of where they should be had it not happened, versus other industries. So now let's talk about some of the misunderstandings that I think I see people kind of throw around all these different numbers and facts, and just in terms of where I think the industry is going, right? So, on its peak, the inflation adjusted total market size was roughly $40 billion. We are basically now at 22 billion most recently. If you think about the US specifically, in the 90s, the late 90s, right, where CDs were still the primary means of consumption, roughly 50% of the population bought a CD and spent on average $80. Okay. Today you have in the US, I think it's around a 50% household penetration, might be somewhat lower than that. And they're probably spending closer to $60 a year. Okay. So when we think about how high the industry can go in terms of size, I think it's going to be multiples what the previous peak was, 2, maybe 3 times. Why? Because streaming is inherently a much superior product than physical consumption. No one disagrees with that, right? I mean, you have, great UX when it comes to the big players, recommendation engines, all the music in the world at your disposal, etc. So this will probably translate into both much higher penetration than we saw previously. Call it anywhere from 75 to maybe as high as 90% of the population having some sort of streaming platform, and also the propensity to pay more and spend more than they were spending previously. So that's kind of the pricing power aspect of it, or incremental monetization means. So that's basically, my big picture view of the industry when it comes to a company like Spotify and a label like Universal Music. The other one that I'm sure you guys have seen, it's sort of a common belief across the investment world, is people will say that music is a commodity, right? And I partly agree with that and partly disagree. Okay, so on its most kind of basic stripped down form, think about the unit of a song, right? Or maybe even an album. Yeah, I mean, you can search for it anywhere you want, right? Like you'll Google it and you'll find it and can listen to it in hundreds, if not thousands of different places. I mean, if you really wanted to, you could probably pirate it as well. Although I don't think there's many people doing that nowadays. But so yes, in that sense, it's technically a commodity. But the other aspect that we briefly touched on before in terms of music is that it's a very highly personal form of media. So when you take a collection of songs, and especially nowadays, that the amount of content is, orders of magnitude larger than what it was 10 or 20 years ago, right? So this is known as kind of the paradox of choice, right? So if you take that content and present it in a personalized, curated way, it becomes highly unique in nature, almost as if it was kind of exclusive content. So something like Rap Caviar playlist on Spotify, or the Spotify playlists that are tailored to you specifically, they become highly valuable, and the labels obviously recognize this as well. So when you look at, on aggregate, the sort of the entire pie of listening that takes place in music as a whole, you're probably looking at maybe around 85 kind of editorial playlists, algorithmic playlists, your own playlist, your friends' playlists, your albums and like songs and all of that, right? So that's the majority of the time you're kind of just using some of those different channels to access your music. You're not picking your songs and just kind of, I mean, some people might just be building queues, etc. But on aggregate, on average, people just, in many cases, just want to be told what they want to be listening to. And that's where I think a lot of the value is being added by some of these platforms, especially Spotify, with kind of their scale and data advantage and curation expertise that they've built over the years.
Interesting. Yeah, like I use Spotify, so as a Spotify shareholder, I feel like you'd be happy for that. But yeah, like I mean, I listen to, like, I always check out Rap Caviar usually on Fridays because that's when a lot of rappers release on Fridays. and the amount that gets uploaded for new music every week, I'm not sure how many songs would be in that playlist during a week. Let's say maybe 30, and almost a third of it gets exchanged per week. So I would feel that album or playlists like Rap Caviar have some type of extreme value that is almost hard to understand from a layman person, such that, like, if you were 55 and didn't really understand the whole music industry, compared to a younger audience sort of like us that
Right.
does understand how important the new releases are on, for instance, like Polo G, a famous rapper. It's just one of those things that I think the valuation is in our and we have an advantage over others.
Yeah.
Based on just that we're in a younger demographic.
Yeah, and that's what's going to kind of drive the industry going forward. It's not going to be the 55-year-olds. It's going to be the 20-somethings and 30-somethings, etc.
Mm-hmm.
Yeah. What are your thoughts on UMG and the recent Pershing SPAC deal falling through?
Yeah. So I will say I was a bit surprised when I read the headlines. I think it was on Sunday or Monday morning, I guess. But this was always a risk, and just to be 100% clear, I never considered myself an expert on the deal structure itself. I'd definitely give a shout out to my friend Andrew Walker, who's done an incredible job breaking out this very complex deal, and he put out a lot of good content on that.
For sure.
I also, knowing kind of, I'm obviously not going to blame this on Ackman specifically, but the deal itself had its own set of risks. It was complex. It was a new kind of structure that hadn't been tried before. It had all these cross-border implications. So it was clearly a risk. And I think when it comes to my portfolio, I sized it accordingly. Like, for me, it was really just a starter position back then. I think it hasn't even really been a month since I invested on it, and all I really wanted was that UMG exposure. And I thought PSTH was at that point the most attractive way to kind of play it and get that distribution versus some of the other alternatives like Vivendi and Bolloré, where I just wasn't as familiar with the other assets that you have to be comfortable in valuing. In terms of PSTH, you basically had cash and some warrants outstanding that were probably easier to value. And yeah, again, my plan was always just to kind of get that UMG distribution and reinvest whatever extra proceeds you'd have from that deal. And as I kept learning more that's usually how I go about some of these investments. I put a starter position when I'm comfortable enough that I know the valuation and the story, et cetera, but I'll keep learning more and more about it and kind of build a conviction, because that takes a little more time. For this one specifically, I was in a position to make a very quick decision, because I was obviously very familiar with the industry and the labels and the importance that a label has on the both on the artist side as well as for the DSPs like Spotify, and UMG being the scaled player and probably the best managed. It didn't take long for me to kind of grasp my head around the valuation and how things could look over the next 5 years. I'm gonna be selling PSTH, but my intention is to find the next best way to kind of get that UMG exposure, whether that be through some of the other holding companies that have an ownership stake on it, or wait for the IPO to take place later this year. We've seen that there may not be as much appetite for this asset, and again, it goes back to what I was saying, that there's just so many misunderstandings in this industry, and I wouldn't be surprised if that IPO takes place and then it kind of declines someone, and you might get it at at an even better valuation. The way I thought about it for me was kind of a 5-year investment, and I could very realistically and I would say conservatively see how the company could double its earnings basically in those 5 years. So that's 15% return, call it, and that's excluding any sort of multiple expansion, dividends, buybacks, et cetera. And all I really looked at was how much does streaming and kind of digital represent of the total revenues, which is somewhere around 60-65% of the company, which again, after we talked about this, but I'm pretty comfortable saying that something like that is going to grow anywhere from 15 to 20% over the long run. So I didn't really have to make that many assumptions on that side. And then, on the other side, which is basically the physical side and things like synchronization and merchandising, et cetera. Just, I called it a mid-single digit decline over the next 5 years, which again, I think is conservative. And put all those together and you basically get a 10% revenue growth over that time frame, and margins going from kind of 18 to 19% to 23, 24. It's important to keep in mind that the operating leverage here is great, because any incremental revenue that they are getting from the industry growth is coming at a very high incremental margin, right? So if you think about, just for any listeners that may not be as familiar with that concept, the incremental margin is what the margin is on that incremental dollar of revenue that you're generating, at which is basically dropping to the bottom line, right?
We're just going to take a moment just to talk about the Quartr app. Quartr is a new way of doing company research. Their first mission is to enable access to conference calls, investor presentations, transcripts, and earnings reports as frictionless as possible, straight to your pocket. Their second mission is to create a completely new way for companies to reach their investors, and vice versa, to change the way people look at investor relations. Their initial core product is now available for both iOS and Android, but stay tuned for additional features during the coming year. So Quartr is 100% free. They also include companies from 15 markets today and plan to add more during the year. They prioritize requested companies, which can easily be done in the app, which, as I've said before, is unbelievable the way that they're able to do that. For an example, I requested Seritage Growth Properties, and within a 3-hour time span, I had an email back saying that your company has been requested and then confirmed on the Quartr app. They have a lot more in store for the following back half of the year, so make sure to follow them on Twitter at Quartr app, and that is spelled QUARTR_APP. Again, that's QUARTR_APP. Now let's go back to talking with Sleepwell. That's super interesting, because I read Andrew Walker's write up on it. I believe he posted it very fast on his Substack. Within out.
And he was on vacation. And he was
in Spain or something like that. And I was like, this is insane. Because from what I understood is that the SEC stepped in based on the fact that they weren't putting 100% of the actual cash into UMG, or was there some type of cash on this side? Like, how does that work out exactly? Because Andrew Walker explained how, with Nicola, how there's a sizable cash position in the business, and the management was taking out quite a bit of it for their own pocket, which is something that the SEC had to step in and say that can't happen. Is that kind of why the SEC stepped in?
Yeah, I'm actually. Yeah, I'll be really clear on that part. I'm actually not entirely sure on that. On those reasons. Again, I point out anyone who's interested on it to go and take a look at what Andrew wrote. I think one big takeaway from why this potentially, why the SEC made that decision, is related to what could have happened if they let this one pass, and how future kind of companies replicating this structure could have abused something like this going forward. Not to say, obviously, we were trusting Ackman in this case that he was going to be very shareholder friendly, but we've seen already very abusive examples of SPACs in general. And the way I understand this structure gave, management even more of that flexibility to kind of just, take cash from the shareholders directly. So I think that was part of it as well.
Interesting.
Yeah.
And you said that you are now going to be out of Pershing Square Tontine Holdings now that they're obviously not going to be doing a deal with Universal, and you'll be kind of waiting for the IPO. What do you expect the IPO to be at market cap wise, or do you just not really have much of an expectation?
Yeah, I mean, probably just kind of echoing those same comments I said before. I wouldn't be surprised if it trades down, but I think, the bankers that they work with will probably work hard to make sure that this IPO kind of takes place successfully, right? Mm-hmm. My hope is that it doesn't pop, obviously, because I want to be a buyer of this asset, but I think we'll see. I mean, this is going to be in the next, I think it's in the next either Q3 or Q4. We'll see what music streaming has done by then in terms of growth. So, there may be some sort of updated valuation using more recent numbers and maybe updated expectations that might probably bring that valuation up a little bit, right? I mean, Tencent bought a stake in I think it was December 2019 or January 2020, but it was also a much lower valuation than what Ackman was paying, which I think it was $42 billion in US dollar equivalent, or 22 or 23 times operating income, something like that.
Okay, interesting. Going on to more of your investment style, back again, what is your time horizon on your investments? Is it 3 to 5 years, 5 to 10 years? Basically, how far out do you look in the future on an investment?
Sure. I think this is definitely one of those questions where the straight up answer is it depends, right? Because each investment is different. There's different kind of investment types and styles. There's investments where I have very good visibility in the next 3 to 5 years, others where I can think about the next 10 and be comfortable. And again, it all ties back to that comment I was talking about before around conviction, right? So, my highest conviction investments, which are sized accordingly in my portfolio, tend to be those where I have that long-term visibility, think about a decade plus. They also have kind of a unique combination of a low downside probability, a lot of runway for growth, and a very strong management team with good capital allocation, a strong culture, etc. And importantly, I have to be very comfortable in my understanding of both the industry, the company, the value chain, for me to kind of underwrite a view of how that investment is going to look like in 10 years or so. So, some examples of the companies that I owned within this bucket are Spotify and Berkshire are basically my biggest holdings. And then there's other companies like Amazon, Constellation Software, U-Haul. These are, I think for me, basically decade plus investments. And the tough part here, and goes back to why it's so important to put in the work and really do your own research and put in the time as well. Is that the toughest part is really holding through it, because they can be volatile, they can sell off at times, they can feel overvalued at different points in times. I think the best businesses in the world at different points in time obviously felt overvalued. But then when you look back in hindsight, they also tended to be very undervalued, because you have companies like, I was just having this conversation on Twitter, I think it was yesterday, with some people, that I think it was Visa and MasterCard have returned something like 28% for the last 20 years or something crazy like that. And I gave the example of Philip Morris, the tobacco company, returning 20% for 60 years and things like that. So anything that returns that kind of performance over such a long time frame just tells you that the stock was basically undervalued the whole time, right? It doesn't matter where you got in, like your performance is basically going to match that on a long enough time frame. So what that comes back to with these very like long time horizon, high conviction ideas, is really being comfortable on what the end game is for a lot of these companies, because that's the way that you're going to be able to go through the toughest period, which is holding through it, right? Now there's this school of thought of like never selling and kind of just being really strict about that. But I think another one of those kind of investing aspects that you have to recognize and balance out is that, it doesn't always work out that way, right? Like things change at different points in times, and obviously you have things like disruption and et cetera, new management teams, things like that. So you have to know where to draw the line. There's that famous Keynes quote that he says, "When the facts change, I change my opinion." Right? It's super sounds super simplistic, but it's really powerful stuff. So again, with these kinds of investments, you have to draw the line somewhere, right? Like I'll give, I don't know, a couple of maybe extreme examples, but if Berkshire kind of loses its culture and its decentralization and capital allocation goes to a place where I just don't think it makes any sense, like that's a good enough reason for me to sell. The same thing applies if Constellation Software starts overpaying for these large software companies, or Spotify slows down on product innovation, or U-Haul stops taking market share on the moving market. So that these are the big, signals that you have to kind of follow and really determine when you're buying these companies, and make sure you're not losing sight of the big picture, and things are either going well and you hold, or things really changed and you gotta make a sell decision.
That makes sense.
Yeah, so that was kind of a long-winded answer for that part, and that's basically one of the buckets for my portfolio. It's probably the biggest portion, but I'm still attracted to certain kind of more traditional value investments, and I think there's nothing wrong with that. I think it's important to maintain that flexibility, and I hate like just being defined in one camp or another. Like, are you growth? Are you value? Are you long term? Are you like? I don't think that's how it works. And the best investors always have that flexibility, right? So, there's companies that attract me for their low valuation, but that's kind of just a filter, and that's when the work really starts, because I learned the hard way that it's not just about buying a stock at a 6 PE ratio and selling it at 10, right? Like there's much more work that's involved on that. And I took part on way too many deep value investments that never really worked out and turned out to be expensive. So what I try to focus on with these lower multiple companies is make sure I'm comfortable with the management team, but also the the earnings growth story. And again, it goes back to understanding that business. It's not really all that different from the previous kind of bucket I was talking about. It just so happens that for these companies, I may not have such a clear picture over the next 10 years, but I'm pretty comfortable with how they're going to look like on the next 5, right? So, one of my bigger holdings is Ally Financial. It's basically the biggest online bank in the US. It had all these sort of I guess I could call them misconceptions, but basically it was trading at a very low multiple post IPO because the assets came from General Motors out of the bankruptcy. So a lot of people just wouldn't touch something like that, right? Just because of the history that it had. But when you looked under the hood, you realized you had an online bank that was growing deposits at 20%, very profitable, and one of the biggest auto retail loan operations, right? So, and at the same time, they were kind of diversifying away from that auto lending business onto things like, more traditional lending, mortgages, credit cards, et cetera. So, these deposits were basically replacing really high cost debt at a very attractive pace. And you had quite a clean story going forward for earnings growth, basically growing at 15 or 20%. And it was trading at that point in time, I think it was trading at maybe 6 or 7 times earnings. And book value was like 0.5 times. And now you got the double benefit of earnings having indeed doubled over the last 4 to 5 years, and the multiple expanded. So it's been an investment that's worked out pretty well so far. And again, it started out as one of those more traditional value investments, but again, I spent time really thinking about how the business could develop over the next couple of years.
Sort of add on to that last question. How many positions do you like to hold in your portfolio? Do you have like a sweet spot maybe?
Yeah, so there's no like hard set rule that I live by. It's more a matter of kind of my bandwidth that I think about how many kind of, if we want to use that metaphor, how many eggs you can look after, right? And sort of maintain that healthy dose of comfort in terms of that, you're following your companies closely enough and understanding what's going on. So, on average, the number is probably going to be around 10, maybe 12. I don't think I've had it above 15 at any point in time. Sometimes, just going back to this flexibility comment that we were discussing, like that doesn't mean I'm not going to get it up to 20 at some point. Like if, I like to think about other type of investments that I haven't actually done these more recently, but at a point in time, I started doing some what is called, special situations, right? Things like spin-offs and merger arbitrage and things like that. And these are sometimes can be as short as a year, like 12 months, 6 months, maybe a year and a half or so. And, it probably makes sense with something like merger arbitrage to build a basket of 5 companies that you think are, have a high likelihood of closing and have a good discount to their acquisition price and things like that. So, again, just if I find those asymmetric kind of risk reward opportunities and I put the work that's required in, I'll make the space for them and just basically size those appropriately, because, for those really big holdings, the top 5 for me is around 75% of the portfolio. So that's really driving most of the value, but these are the buy and holds, right? So for those big ones, it's all about the downside, right? And really making sure that you understand those risks and you're being properly compensated on the upside, right? But these smaller examples that I'm talking about, some of them might not work out, and I'm perfectly fine with that, as long as over time, on average, they provide a satisfactory return.
So as I can see, like in your portfolio, give or take, your top 5 positions are over 60% ish. Do you come from that, I guess, school of investing where Buffett talks about diversification compared to diversification? Like, where do you think the amount of stocks that you own starts to almost put a negative on your portfolio?
In terms of the biggest positions becoming too big or something like that?
Yeah, like, I mean, just like you said, eventually you could get up to 20 positions, but then at how many positions do you think that it gets too bad for the portfolio where it almost does diversification?
Right. So again, if that 20 is because I have 7 positions that I think about almost as a bucket. So call it in this case, maybe, special situation type investments start becoming really, really attractive. Like I'm fine building a collection of those. And I don't think that's gonna be to the portfolio's detriment. At the other hand, I think they probably provide a pretty, or I mean, at least the idea when I'm kind of underwriting the investment is that they provide a very satisfactory return. In terms of like having individual companies, I don't think I could get to as high as 20 if there are companies that you have to be following them relatively closely, understanding what's going on and talking to people in the industry, going through their earnings, things like that. Another kind of exercise that I try to apply to my portfolio with some of these smaller positions is that, especially those that I've sort of started building with the intention of making them larger positions as I learn more and more and become more comfortable with the long-term story, is I like to tell myself that the small positions really have to earn their spot on the portfolio. They're either gonna be built in size as I reach that required level of conviction, or eventually I just don't think it makes sense to spend more time on it and I replace it with something that I think is more attractive. Like sometimes I'll sell a 2% position and buy more Berkshire because I've already done the work and I know the valuation pretty well. I follow it closely and it's going to be an easy decision for me. So I think you always have to be comparing some of those smaller decisions and maybe new decisions in general to what you already know and own and know pretty well. That makes sense.
Oh, that totally makes sense.
I think so.
Do you have any non-10K research strategies or content that you like to read or watch or listen to? Like, how do you kind of go about when you're making your, I guess, investment thesis?
Yeah. So just to be clear, the 10K and all the filings are super important, and I do spend time on that. But there's definitely, I mean, most fundamental investors do. So as part of the process, I think you have to go out of your way and as you suggested in this question, just kind of find these other resources that a lot of people may not be looking at. So, the most basic one is reading books, right? That's such a great way to learn about an industry, learn about a company, really test yourself in terms of if you're interested in studying that company, right? If you read a book about a company and enjoyed it, chances are you're going to enjoy looking more closely at the company and studying it, right? So that's, I mean, I'd encourage everyone to read, and not only, not only books related to maybe the things you own, but things you might be interested in, or there's just so many books on businesses and, kind of manager or CEO, founder biographies and things like that. that teach you a lot about the business and the industries. On that same note, I think talking to industry insiders and people that know the industry really well. You know, I have a friend who is a songwriter signed onto a label, has his own kind of performance artist music project signed with another label, and then has a rock band as an independent. So he's a great person to talk to and kind of get a grasp of the differences between being on a label and being with an independent label and being independent. So these are the kind of things that I think make, you know, can separate you from other investors. And it doesn't have to be someone you know. Obviously, nowadays with podcasts, I think podcasts are incredible resources when it comes to researching companies. Like, you'll be surprised how many hits you get when you search for, you know, company X interview, and you'll find executives getting interviewed and things like that. There's just so much content out there. And big thanks to Patrick O'Shaughnessy. I think he's a very, you know, we all owe a lot to him on the investment community. He's been such a strong force with all his different podcasts that he's putting out. Obviously, Invest Like the Best is one of the really great ones, but this more recent one where he breaks down businesses, it's just an incredible way to learn about a company in like less than an hour. So I think that's another great resource. And on that same note, Twitter is incredible too in that sense. If you think about people pitching stocks on Twitter, it's usually through a thread, right? And it's such an interesting way to read about a stock, because they're being forced to only give you kind of the highest signal information, right? The most important drivers, aspects, and so it's a great way to filter, right? In that sense. And I've seen some really good threads that by just reading the thread, I became so interested in the company. Obviously, it always depends on who's writing it, but there's really good ideas that you can find and kind of curate through your feed. And I think finally, it's always important to talk to people that have opposing views to your own, right? And spending time really understanding the bare thesis of all your investments, and just being kind of really open-minded in terms of because it's not easy, right? Sometimes it's tempting and you almost want to take it to like a more aggressive discussion, but it's one of those things that I think every investor has to work on, and goes back to the importance of the psychology I was talking about. It's such a personal endeavor that we take on, and we have to be so cognizant of that.
Yeah, for sure. I mean, I'm always interested usually in the bear case before I'm even interested in the bull case. Yeah. Just so that I don't get way too excited, because usually when you're reading something on a bull case, or if you're reading through even a 10K, it's pretty bullish within the 10K, even though that it's all filled with lawyers' writings. They can make it seem a little more optimistic than it really should be. But yeah, I'm interested in the bear case, and I'm like, okay, if the bear case isn't that bad, then what is the bull case? And then if the bull case is like extraordinary, then I'm like, okay, you know what? It goes back to that Munger thing. The Munger quote is always invert.
Yeah.
And if you're going to invest in a business, look at the reasonings that it's not that great.
Yeah, exactly. Like, if you want to learn about the great businesses, look at the bad ones, etc. That's such a powerful mental model to live by and really apply it. I think there's two other things that came up when it comes to just kind of this whole research process. One that I've come to realize has a lot of benefits is writing, right? I think you don't really understand what your thoughts are on something until you sit down on a blank sheet of paper, whether that's on the computer or a notebook, and really start writing down what your thoughts are on a company, and just really, being able to dumb down the big picture thesis on any investment. Writing helps out so much on that side. Another interesting idea that one of my friends from Twitter, Josh Tarasoff, he's talked about this in the past. he points out that one of the most important steps of his research process involves getting distracted for like an extended period of time. And, kind of, if you spend 2 weeks looking at a company, you forget about it for another 2 weeks, and then you come back to it, and you'll realize that you come at it at a fresh perspective, and you maybe start seeing things differently and realize some things that you might probably hadn't noticed before. And I guess in my own personal words, that would be kind of sleeping on the investment. And I just think that helps out a lot as well. It's one of those things that it may sound obvious when you say it, but a lot of people are probably not doing that,
Yeah, I never thought of it that way.
No.
Never thought of it doing 2 weeks of research and then taking 2 weeks off and come back at a different angle. That's really interesting.
Yeah, just so you're not kind of like drowning in information, if it's bearish or bullish, you get to make your own thoughts and opinions over that 2 week span, and then go back. You sit and think. Exactly. Yeah.
Exactly.
No, that's definitely interesting. I might take some of that, and I might take that into my own consideration and try it out for once. Sure. Both of us have read through your Substacks. I have like some of them right here, actually. Nice. And so I've read through them all. Have you read through them all, Jake?
I've read through the first two there.
Okay. Yeah. I really enjoyed them, and I really think they're great. Do you want to explain a little bit more about how your Substack works or what you're about on Substack?
Yeah. So in large part, it's very related to what I was talking about when it comes to writing, right? And it's just such a powerful exercise, and I've enjoyed the writing process over the years more and more. And I think if you asked me 5 years ago, I would have never told you that I'd become some sort of writer. But Substack for me was definitely a happy accident, in the sense that I was, started using Twitter, and more specifically FinTwit, in the last 6 months, and realized that very smart people were putting content out through that platform. So I decided to kind of test it out and see how it worked. In the beginning, the idea was to talk about topics where I thought I could bring something to the table that was differentiated, unique, and ideally places where I think people are very interested in studying, but maybe there's not as many resources out there, or there's a lot of misunderstandings, etc. So obviously the music streaming royalties 101 being kind of the prime example of that. And it's been, the results so far for that one, and feedback has been really great. And it's been awesome to see that kind of been sent around over the past few months. But yeah, so the other ones, I still think I'm trying to, talk about something that's unique in its own sense. So Spotify's Locker Room acquisition, that was kind of my quick take on that news that I don't think had enough coverage. I also talked about on another piece some of the lessons that I brought over from fixed income to being an equity investor, and how I think certain people can benefit from learning about that. U-Haul being the most recent one, I think is a fascinating company that definitely doesn't get enough attention, has zero sell side coverage. A lot of people don't even know it's public. So that's another one. And this next one that it's dragged on for longer than I would expect it, because it was, as I said, it's such a difficult topic to get your mind around, but it's going to be on investing conviction. And it's definitely a more kind of philosophical piece, and just looking at what investing conviction means for me as an investor, and how I, kind of take certain steps to arrive at that level. So it's very varied, as you can see. There's not one specific kind of topic or niche that I'm trying to focus on. I'm just trying to look at things that interest me a lot, and hopefully people will also find it interesting.
Yeah, like, I mean, it goes from Spotify to U-Haul to Conviction. I mean, I really enjoyed just reading up anything that I can of information that I wouldn't usually come across, which I found is on your Substack, is information like you said, is things that are either overlooked or not enough research on for people to really make a strong opinion on. And like, yeah, if it wasn't for your Substack, I don't think I would have even known that U-Haul was a public company. So no, I'd highly recommend for anybody to go and subscribe to a Substack, and we'll definitely put in the link down below.
Appreciate that. Thank you.
No problem. Well, it's been great having you on. We don't want to put you past the time, and we thank you very much for giving your time up for us for this podcast. Do you want to do any shout outs, like for where they can find you?
Yeah, so on Twitter, I'm Sleepwell Cap. On Substack, sleepwell.substack.com, and those are basically the main two channels. If you feel free to reach out via Twitter, my DMs are open anytime. I'm always happy to chat with anyone.
Well,
and
great.
Thanks so much for having me. This is a lot of fun. Hopefully we can do it again in a few months.
That'd be awesome.
Thanks for coming on.
No, we'll maybe when there's more information about the UMG IPO, then we'll definitely have you back on, and or even talk about U-Haul. So
yeah,
no, thank you very much. Thank you very much for coming on with us today, and we'll see you in a couple of months, I guess.
Sounds good. Talk soon, awesome. Mitch and Jake.
Yeah,
thanks.
Talk soon. Thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for your entertainment and education purposes only, and we hope that you enjoyed it.